Are you split between FHA and conventional loans? Well, don't worry, I've got you covered. In today's video, we'll explore the world of home loans and compare both loan types to help you make an informed decision. We'll also dive into the nitty-gritty bits of credit scores and show you how to increase your chances of getting approved. So whether you're a first-time buyer or a seasoned homeowner, the loan approval process can be daunting, but I can promise by the end of this video, you'll have a solid grasp of credit score requirements and some actionable tips to give yours a boost. So let's get started. Glad to have you back on the channel. I'm Andy from Credit Sage, where we help you achieve your credit goals and pave the way to your dream home. With over 3,000 reviews and a 4.9 out of 5 Trustpilot rating, you can trust that we know what we're talking about. And today, I've got some crucial information that can help take your credit game to the next level. So get set to make your dream of home ownership a reality. Now, FHA and conventional loans are two of the most common loan types available in the market today. And each has its selling points. And of course, each one has its drawbacks, depending on your specific housing goals and credit situation. Now, we'll begin with conventional loans. Conventional loans are the most common type of loan and are not guaranteed or insured by the federal government. Rather, they are offered by private lenders such as banks and credit unions or mortgage companies. And this, of course, has its benefits. The main one being that they're more flexible than government-backed loans. Okay? And they have higher limits than other loan types, which means that borrowers can finance more expensive properties. But that's not their only selling point. With conventional loans, you can skip mortgage insurance. All you need to do is make a down payment of at least 20% of the home purchase price. Additionally, conventional loans can be used to purchase all sorts of property types, including primary residences, secondary homes, even investment properties. Of course, we can't deny that they have their drawbacks, all right? They can be more difficult to qualify for than government-backed loans. Conventional loans typically require higher credit scores and lower debt-to-income ratios. Additionally, conventional loans may have higher interest rates than government-backed loans, depending on borrowers' creditworthiness and other factors. And finally, borrowers may have to drop larger down payments than government-backed loans would require, which can be challenging depending on your financial situation. Now, moving on to FHA loans. These are backed by the Federal Housing Administration, FHA. They're a great option for many home buyers for reasons such as their lower down payments requirements. FHA loans only call for a 3.5% down payment, unlike the 5% standard for conventional loans. This could be a big help for people who don't have a lot of savings to put down toward a down payment. Second, FHA loans have less strict credit requirements than conventional loans. While conventional loans generally require a credit score of 620 or higher, FHA loans are available to borrowers with credit scores as low as 580. If your credit score is below 580, you may still be able to qualify for an FHA loan, but you'll need to put down a larger down payment. Like conventional loans, FHA loans also have their limitations. One of the major limitations is the requirement for mortgage insurance premiums, MIP. Borrowers who take out an FHA loan are required to pay MIP for the life of the loan, even if you build up equity in the property. Another issue is the loan limits, which vary by location and can be lower than conventional loan limits in some areas. Now, both loan types work similarly as the lender evaluates your credit worthiness and a few other factors to decide if you can and will repay the loan. However, the requirements vary because each loan has a different target demographic. So conventional loans are best suited for borrowers with strong financial profiles who can meet the stricter requirements for credit scores, debt-to-income ratios, and down payments. So if you're in this category, a conventional loan might be just the thing for you. Also, if you're planning to buy a second home or an investment property, a conventional loan is likely the way to go. FHA loans, on the other hand, are designed to help those who may not have a lot of money saved up for a down payment or have a lower credit score. They're also targeted for first-time buyers and work well for borrowers who may not qualify for conventional loans due to their financial situation. And additionally, I want to say that FHA loans are a great choice for those who have a previous bankruptcy or foreclosure on their record, as they tend to be more forgiving of past credit issues. So, if you're torn between an FHA and a conventional loan, The first thing to do is look at your personal needs and unique financial situation. Then go for the loan option that best fits your plan. Now, I already mentioned some of the things you can look out for, but let's review them just to make sure. Down payment. With an FHA loan, you can put down as little as 3.5% of the purchase price, which can be a game changer if you don't have a lot in savings. Conventional loans usually require a higher down payment, anywhere from 5 to sometimes 20%. Credit score. If your credit score isn't perfect, an FHA loan may be a good option since they're more lenient than conventional loans. But if your credit score is solid, you could qualify for better interest rates and terms with a conventional loan. Property type. FHA loans are designed for primary residences, while conventional loans can be used for a wider range of property types, including second homes and investment properties. Loan limits. FHA loans have maximum loan limits based on where you live, while conventional loans may not have any limits or have higher ones in certain areas. Mortgage insurance. FHA loans require mortgage insurance premiums, MIP, which can increase your monthly payments. With conventional loans, you may need to pay private mortgage insurance, PMI, until you build up a certain amount of equity in the home. Regardless of what you ultimately go for, your credit score is a big factor because it can have a significant impact on your approval odds, as well as the interest rates and terms you will be offered eventually. A higher credit score is a reflection of your relationship with credit. It tells lenders that you're more likely to pay back and to pay on time. This makes them willing to give you a loan. Now, I mentioned that conventional loans need a minimum score of 620, while FHA loans usually require about 580. Even if you have either of one of these amounts, it's good to aim higher so that you can get the best terms possible. Now, I recommend using credit repair to improve your score and approval odds, and the best way to do this is to hand it over to us here at Credit Sage. If you don't have the time or the know-how to manage your score, you can cut down on the stress by reaching out to Credit Sage. Our team of experts is familiar with the ins and outs of all things credit. Just put a call out to us using the number below and we'll take it off your hands. However, if you are willing to take on the task and willing to invest the time to build your credit yourself, you should be aiming for a score of at least 740 or higher to get the best interest rates. The first practical step is to get a hold of your credit report. You're entitled to a free credit report every 12 months from each of the 3 major credit reporting agencies. What you want to do is go through that document and spot any errors that could be dragging down your score. Now, if you do come across any, then you should dispute these inaccuracies with the agency. To actually start improving your score, one thing you need to do is pay your bills on time. As simple as it sounds, late payments can drastically affect your score. So set up automatic payments or reminders to ensure that you never miss a payment. Now, another vital factor to consider is your credit utilization ratio. This ratio compares your credit usage to your credit limit, and keeping it under 30% can do wonders for your score. If you have high balances, make a plan to pay them down as much as possible. Whenever you apply for credit, it generates a hard inquiry on your credit report, which can temporarily lower your score. Therefore, unless it's absolutely necessary, avoid applying for new credit, especially if you plan to apply for a mortgage soon. Also, keeping old accounts open. Even if you don't use them anymore, they can improve your credit score by lengthening your credit history. In contrast, closing out those old accounts can hurt your credit score. If you're struggling to build credit, you could consider a credit builder loan or secured credit card. These options can help you to make small monthly payments that the lenders report to the credit bureaus, gradually improving your credit score. So in conclusion, improving your credit score takes effort and it takes time. By following these steps and taking a long-term approach, you can build a strong credit history that will benefit you in the future. Now, let me tell you, it's natural to feel overwhelmed. And after hearing all these steps, you may be even more overwhelmed. But don't worry. If you feel like managing your credit is too difficult on your own, then reach out to Credit Sage because we're here to help. Signing up only takes a few minutes, and from then on, managing your credit is off of your shoulders. Our experts will take care of everything you need to get you the credit score you need, setting you up for home ownership. Now, if you found this video helpful, please show your support by hitting the like and subscribe button to our channel for new videos each and every week. Thanks for watching.